This video will get us started on the earnings per share topic, which wraps up chapter 16. And there are three things that I'm going to try to convey to you through this screencast. And one, we're going to start out with what is earnings per share and why is it so popular. Then next I'm going to move and try to explain to you something we call simple versus a complex capital structure and how that relates to earnings per share. And then lastly, I'll wrap this thing up by giving you an example of how we calculate earnings per share only using the simple capital structure. This is an extremely popular metric or measurement used by the financial press, by investors and stock analysts. And so therefore a corporation is extremely concerned about it or cares about it when they're looking at managing their profitability, but there are some things that we need to understand, and one is that we only calculate earnings per share for common stockholders. So there's no earnings per share for preferred stockholders, there's no earnings per share for treasury stock. It's all earnings per share for a common stockholder, which, if you can see down here in the green, I've actually listed what the earnings per share calculation is, and we start with our net income. And you can see right here we're going to subtract out any preferred dividends, holding true to the fact that it's only for common stockholders. And then we divide that by something called the weighted average number of shares outstanding, which I will explain to you in a future video. And the last thing in regards to its popularity is that it's become so popular that the SEC has said, well, we require you now to report it on your annual report. And that's typically reported right below net income. There is one exception, and that is that if a company is not public, they're a privately held corporation, they're not subject to reporting or disclosing their EPS for cost reasons. So when we look at the two types of capital structures, and by capital structure we mean what is the makeup of the stockholders' equity. We have one that we call simple, which is where we will be focusing, and the second is called a complex capital structure, which will be a future video. So simple capital structure is inclusive of only common stock. So if they have preferred stock, they're typically not a simple capital structure. They have two types of stock classes, and so we reserve simple capital structure for the common stock. And this is also very important here, there is no potential common stock outstanding. So in other words, we've talked about convertible bonds, we've talked about stock warrants, restricted stock. If that company has any restricted stock, any convertible bonds, they would not be considered simple capital structure. They would be considered a complex capital structure because they have securities that might have a potentially dilutive effect should they be exercised or converted. And so therefore we want to we have a different calculation when we talk about simple versus complex because of that dilutive nature. So I've come up with a very basic example on trying to illustrate to you what earnings per share looks like when we calculate it. So I've made up, let's assume that we have a company over here, it's a lemonade stand, and that lemonade stand needs some money to initially start their operation. So they go and they find some stockholders. They find two stockholders, and on January 1st of 2011, the lemonade stand sells 2 shares of stock, common stock, not preferred stock. They only have common stock. So there are 2 shareholders, shareholder 1 and shareholder 2. There are 2 shares outstanding. And so in 2011, we'll also assume that this company had generated, they're publicly traded, they've generated their income statement, and at the bottom they have net profit, net income of $10. So these shareholders up here are saying, okay, well, how much of that $10 do I really was generated because of my 1 share? And this is why it's so important, because if that $10 had to be spread out between 10 people, that's a whole different meaning than if it were spread out between 1 or 2 shareholders. So if you see down here, I have the equation listed again. Net income minus preferred dividends divided by weighted average shares outstanding. And so the net income is obvious here. I'll do the calculation up here. The net income is $10, which I got from here. And I have no preferred dividends, so I'm going to subtract 0. And I divide that. Now this is something that will get complicated, but I'm going to keep it very simple here. Weighted average number of shares outstanding. So we have to look back and we say, okay, during 2011, how many shares were outstanding? And these happen to be, conveniently, issued on January 1st. So they were outstanding for the entire year. So I have 2. And there were no other subsequent issues of stock. So had these shares been issued halfway through the year, and this profit was generated on an annual basis, you cannot say that both shares have a proportional distribution of that net income because they weren't outstanding for the entire year. But these we're going to say they are. So my earnings per share in this example is a simple $5. A very, very unrealistic example, but I think it at least conveys the point of how we calculate earnings per share if we have that simple